Welcome to the Daily Drawdown, where defense budgets, AI capex, and market rotation are moving fast. The big shift right now is simple. Markets are rewarding hard assets, cash flow, and real-world capacity a lot more than expensive promises. That shows up in NATO spending, AI debt issuance, energy constraints, and the pressure building under crowded tech trades. At the 2026 NATO summit, 31 of 32 members backed a path towards spending 5% of GDP, roughly 3.5% for core defense and 1.5% for infrastructure. Why it matters is scale. Allies have already added about $250 billion in extra defense spending over the past 2 years, and this pushes that trend further into procurement, manufacturing, and logistics. The U.S. is making the pressure explicit. Spend more or expect less American support. That burden-sharing message is also driving more transatlantic industrial tie-ups, including Lockheed's ultra-maritime deal and Raytheon co-production talks. For markets, this keeps defense, aerospace, munitions, and military infrastructure in the group of sectors with durable demand visibility. What to watch next is whether governments actually fund the pledges and whether political rhetoric out of Washington starts undermining alliance cohesion faster than budgets can reinforce it. On oil, the message is that geopolitics is back to moving prices in abrupt bursts even when longer-term supply fundamentals look less alarming. A June 22 waiver, allowing limited Iranian oil sales, helped trigger a more than 5% spike that afternoon, and when Treasury later revoked it, crude jumped again, about 4% to 71.40 cents. Missile strikes near the Strait of Hormuz also pushed prices higher, and analysts keep pointing to the same pattern. Waiver headlines, tanker attacks, and troop withdrawal threats can all become instant volatility catalysts. The practical implication is that energy remains a live hedge against both geopolitical stress and tech concentration, especially because energy still has low long-term correlation to tech-heavy portfolios. The AI build-out is no longer just a growth story. It is increasingly a credit story. Amazon launched a $25 billion bond deal and reportedly told underwriters it does not plan to issue more debt this year. That comes after earlier borrowing on a very large scale tied to a multi-hundred-billion-dollar AI and data center investment push. Across hyperscalers and major tech issuers, cumulative bond issuance this year is already being discussed in the hundreds of billions. Why it matters is that investors have been willing to absorb huge size and long maturities, which tells you the market still believes AI infrastructure can earn its keep. The tension is obvious. If free cash flow gets squeezed hard while data centers, GPUs, and power costs keep climbing, then debt-funded capex starts looking less like growth finance and more like a duration bet on future monetization. What to watch is when credit buyers start demanding more proof of ROI instead of just accepting scale, brand, and AI optionality. That financing issue ties directly into the broader unwind in AI momentum names. Several desks still think the sell-off in overheated AI and mega-cap names is not done, with some calling for another 20% to 25% leg lower after any rebound. The core concern is valuation meeting a more cash flow negative reality. Hyperscalers are still growing, but the market had priced them like they could keep over-delivering without meaningful capital strain. At the same time, money is rotating toward businesses that own infrastructure, generate cash, or benefit from physical bottlenecks. Industrials, defense, utilities, and some defensive names have been gaining relative ground. You can see that in equal-weight indexes outperforming cap-weighted benchmarks and in reduced small-cap AI exposure after index rebalancing. This matters because it changes what leadership looks like. The winning factor may be less pure software upside and more control of power, equipment, manufacturing, and regulated assets. Market structure is making all of this sharper than it would otherwise be. Leveraged single stock and sector ETFs have grown fast, with estimates around $200 billion of long-only leveraged ETF notional in tech and a heavily one-sided long bias. That means fewer natural shock absorbers when momentum turns. Add retail margin, hedge fund leverage, and concentrated options positioning, and the market can flip from risk on to risk off very quickly. For listeners managing exposure, the point is not that leverage causes every sell-off, it is that leverage can make crowded trades break harder and faster once they start unwinding. SpaceX is getting a major public market-style repricing after entering the NASDAQ 100, with passive demand estimated around $4.3 billion and very wide analyst valuation ranges. Near term, the big issue is lockups. Analysts are warning that expiring restrictions could release meaningful stock and create volatility, even if the long-term story stays intact. The private market compounding has been enormous. One investor says a 1% stake is worth about $20 billion, which tells you how much value creation has accrued before broader public participation. But the fundamental caution is Starlink. Analysts do not see it as an easy terrestrial wireless replacement in dense urban markets because of signal limits, battery constraints, and terminal economics. So the next leg of the thesis depends less on hype and more on execution, Starship reuse, actual launch economics, and whether Starlink can partner with carriers instead of trying to brute force a full wireless substitute. Semiconductors still have the best structural demand story in the market, but the tape is getting less forgiving. Samsung posted an extraordinary profit surge, yet the stock still fell as investors questioned how long pricing and earning strength can really last after a huge run. Memory prices have been climbing, but there are growing concerns about overcapacity, new issuance, and bearish positioning across the group. And NVIDIA still sits at the center of AI compute, and ASML remains a key upstream choke point, which is why both continue to anchor long-term bullish views. But the short-term message is different. Even strong fundamentals are not enough if positioning is crowded, and investors are starting to rotate away from the highest beta winners. The AI build-out runs straight into the physical grid. In the PJM region, about 20% of electricity still comes from coal, and replacement generation is not being added fast enough to retire that capacity cleanly and cheaply. Large data centers also impose transmission and reliability costs, and the push now is for operators to build behind the meter or pay more of the upgrade bill instead of socializing it across other ratepayers. That is relevant for utilities, power developers, gas infrastructure, and for any AI capex model that assumes compute can scale without friction. Housing is moving toward balance. 44% of agents now describe the market as balanced, up from 30% a year ago, with more inventory, slower price growth, and better negotiating power for buyers. That suggests the next move depends less on mortgage rates alone and more on whether nominal home prices actually soften enough to restore affordability. On healthcare, Eli Lilly keeps delivering. Its GLP-1 franchise produced a $1.5 billion sales beat, and the pipeline is reinforcing the view that obesity drugs remain one of the clearest large-scale growth markets in healthcare. That's the brief for today. Defense up, debt up, leverage high, and leadership rotating. You're listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.